Welcome to Talk Tickers, the show that takes a deep dive into earnings calls, cutting through the noise to bring you the essential insights you need. Today, we're dissecting the second quarter fiscal year 2026 earnings from Science Applications International Corp., or SAICT. Our mission, as always, is to boil down the critical information, understand management's viewpoint, and connect it to the broader market, giving you that well-informed edge. And with SAE this quarter, well, we've got a fascinating paradox to explore. Falling revenue, but soaring profits. Is this a temporary blip for a solid government contractor, or does it signal something deeper, maybe a structural shift? Let's get right into it. SAI's Q2 FY26 was, without a doubt, a mixed bag, and the market certainly made its feelings known. On one hand, profitability absolutely crushed it. Their non-GAAP EPS, which generally gives us a clearer picture of core operations, came in at $3.63 a share.
Yeah, $3.63, that's what, 62% above the consensus estimate of $2.24? Just blew it away?
Exactly, blew it away. And net income jumped by a healthy 57% year over year. Free cash flow for the quarter was robust too, $150 million.
Right, and adjusted EBITDA, another key one, hit $185 million. Strong margins there, 10.5%.
Yeah, margins up 110 basis points year over year. Really solid on the profit side. But here's where the story gets tricky. The top line told a very different tale.
That's the other shoe dropping.
Revenue actually missed expectations, clocked in at $1.769 billion against a consensus of $1.86 billion.
Oof, that's almost a 5% miss. And a 3% decline from last year. Not great.
Not great at all. And despite all those fantastic profit and cash flow numbers, the market's initial reaction was notably cautious, clearly weighed down by that revenue miss.
Understandably so. Revenue is growth.
Right. Now, for a positive sign looking ahead, bookings were strong, $2.6 billion.
That gives them a book-to-bill of 1.5 for the quarter, which is really quite impressive. It means they're winning work faster than they're burning through it.
Definitely. And the company's total backlog now stands at a substantial $23.2 billion.
Yeah.
So the pipeline for future work is definitely there.
It's there, yeah. Big backlog.
So that's the headline. A profit beat masked by a revenue miss. The big question becomes, what's driving these diverging trends? Management explicitly laid out three key factors behind the challenging revenue environment they're seeing.
Okay, let's unpack those.
First, they pointed to a slower conversion of what they call on-contract growth opportunities into actual revenue.
Right. So existing contracts just aren't expanding as quickly as they thought. Less scope creep, maybe less add-on work.
Exactly. We saw this manifest as on-contract growth slowing significantly. It was 3% in Q2, down from 8% in Q1. That's a pretty steep drop.
It is. Any specific examples they gave?
Yeah, they mentioned the Army's S3I in Huntsville apparently faced a double-digit budget cut.
Ouch.
And the Department of Treasury's P-Cloud program, which experienced significant delays. They even mentioned some headwinds in the Space Force arena, too.
Okay, so multiple areas feeling that pinch. What was the second factor?
Second, just an increase in the impact from general program disruptions. Kind of vague, but implies things just aren't running smoothly.
And the third?
Third, ongoing delays in new business awards. Plus, slower ramp-ups for contracts they have recently won.
So even when they win, it's taking longer to get the revenue flowing.
Precisely. They mentioned TINCAP and the USAF HOPE 2.0 as examples there.
And their explanation for why this is all happening.
They describe these issues as results of government efficiency efforts, personnel turnover, and new processes. Importantly, they said it's not about losing market share to competitors.
That's a key distinction. They're saying it's the environment, not their competitiveness.
Right. But it's led to a significant guidance reset for both fiscal year 2026 and 2027.
Let's hear it.
For FY26, revenue guidance was cut pretty sharply, down to a range of $7.25 billion to $7.325 billion.
Wow. What was it before?
Earlier, it was $7.60 billion to $7.75 billion. So quite a haircut. They're now projecting an organic contraction of 2% to 3% for the year.
Organic contraction. Okay. And they expect declines in Q3 and Q4 specifically.
Yeah, about 5.5% organic decline in Q3 and 4% in Q4. So the pain continues near term.
Okay, revenue down, but you said profitability guidance was different.
Yeah, this is the fascinating part. Despite cutting revenue, SAIC actually raised its adjusted EPS guidance for fiscal year 2026.
Rose it? How?
They're now expecting $9.40 to $9.60 per share. That's up from $9.30 previously.
Okay, so lower revenue, higher earnings per share. That usually means margins or taxes.
Taxes, primarily. They had a favorable tax settlement in Q2, and they revised their full-year effective tax rate assumption down to a remarkably low 14%.
14%. Wow. Okay, that is low. That explains a lot of the EPS bump then.
Definitely. And this lower effective tax rate for FY26 is a really crucial nuance here.
Right, because it's probably not sustainable at 14%.
Exactly. If we connect this to the bigger picture for FY27, SAIC is projecting adjusted EPS to be a bit lower in the $9 to $9.20 range.
Still strong, but lower than the revised FY26.
Right. And that's assuming a more normalized effective tax rate around 23%.
So that difference in tax rates between this year and next year, that's like nearly $1 in EPS right there.
Pretty much. It highlights the likely temporary benefit they're getting this year. Think of it like a temporary tax golden ticket boosting this year's numbers.
Got it. A one-time or at least short-term boost. What about cash flow? Did that follow earnings up?
It did. Get this. Free cash flow guidance was also raised for FY26 to greater than $550 million.
Okay.
And they're projecting around $600 million for FY27.
So this raises an important question, right? Why the FCF increase despite lower revenue and presumably lower core operational earnings before interest and taxes?
You guessed it again. Taxes play a role here, too.
Ah, okay. How so?
You know, this, too, is largely thanks to something called the Section 174 tax changes.
Yes, the R&D capitalization rules. That's been a big topic.
Exactly. In simple terms, this provision changed how companies deduct their research and development expenses for tax purposes. And for SAI, it's temporarily creating a significant cash tax benefit.
Right, because they have to capitalize the expense for book purposes, but get different treatment for cash taxes, at least for a while.
Precisely. They're expecting a cash tax benefit of approximately $60 million in FY26.
$60 million. Okay.
And even more, about $110 million in FY27.
Wow.
With an estimated total benefit of over $200 million across FY26 through FY28.
Okay, so that tax tailwind is really cushioning the impact of lower expected operational earnings on their free cash flow. Makes sense now.
Yeah, it's a huge factor in that raised FCF guidance. So given these challenges, how is management planning to navigate these choppy waters? What's the strategic response?
Well, they emphasized taking, quote, purposeful action to align our cost structure with the more challenging revenue environment.
Okay, cost cuts, basically.
Sort of, but also efficiency gains.
Yeah.
They mentioned leveraging their enterprise operating model and accelerating the adoption of artificial intelligence across core functions.
AI for efficiency. Interesting.
Yeah, aiming to drive margin improvement and customer savings. They said we'll hear more specifics on the Q3 call.
Okay, and what about winning new work?
They're committed to protecting submission volumes for new bids and maintaining strong win rates. They're targeting 80-90% for recompetes.
Which are existing contracts up for renewal.
Right. And 30-40% for completely new business, which are pretty strong targets.
They also had that quote, right, about not wasting this crisis.
Yeah, they framed it as a catalyst to accelerate their pre-existing strategy.
Which involved
Shifting the portfolio towards higher margin enterprise and mission IT, focusing on differentiated capabilities and integrating more commercial technology.
so less pure labor, more value-add tech integration.
That seems to be the idea. They see themselves as a mission integrator, helping government use commercial tech effectively.
Right.
They even said they're welcoming a shift towards more fixed price and outcome-based programs where they feel they have a strong track record.
That's a bold statement, isn't it? Claiming to use headwinds as a springboard. It's certainly a great narrative, but how much of this is real strategic momentum and how much is management simply putting a positive spin on a tough quarter, in your view?
That's the million-dollar question, isn't it? I mean, the strategy sounds right for the evolving market. Focusing on higher margin IT and integration makes sense. Using AI for efficiency is smart, but the proof is in the pudding. Can they execute this pivot while managing these revenue headwinds and delays? That's what the market is watching. It's easy to talk strategy, harder to deliver results in a tough environment.
Fair point. And despite the challenges, they did announce some big wins in Q2, right?
Yeah.
To back up the bookings number.
They did, several significant ones. A huge $928 million contract with the Air Force for the HOPE 2.0 prototyping program.
Okay.
A $728 million cloud task order for the Department of the Treasury.
Right.
And a $547 million extension of the State Department's IT Vanguard contract, among others.
So some really substantial wins.
Absolutely. These contributed to the strong bookings, bolstered that big backlog, and they do provide future revenue visibility eventually once these programs actually ramp up.
Right. The ramp-up timing being the key uncertainty now. So what does this all mean for you as an investor navigating this landscape? The market certainly made its feelings clear on September 4th.
Yeah, the stock reaction was pretty swift.
SAIC shares traded lower during and after the earnings call, closing down almost 7%.
7%? Ouch!
On volume nearly 3 times its 90-day average, so heavy selling pressure.
Clearly indicates the market's laser focus on that top-line contraction and the revenue guidance cut, despite the profit beat and strong cash flow.
Definitely. And just to put SIX performance into perspective, its total return over the past year leading up to the Q2 close was actually negative 4.1%.
Negative 4% over a year, while the broader defense sector has been doing well.
Exactly. It significantly underperformed the iShares U.S. Aerospace and Defense ETF, ITA, which was up nearly 40% over the same period.
Wow. That divergence really underscores the specific headwinds SI is facing with this on-contract growth issue and the award timing delays. It's not just a sector thing.
No, it seems company-specific, or at least specific to their customer mix and contract types right now. During the Q&A session, analysts really pressed management on some of these key issues.
I bet they did. What were the main topics?
Well, there was significant discussion around whether the market changes they're seeing are temporary delays, maybe 3 to 5 quarters, or if this is a more structural reset, potentially lasting 3 to 5 years.
Yeah, the million-dollar timing question again. What was management's take?
Their view is that while they believe much of the revenue headwind is temporary and will normalize, they are planning and managing the business as if these disruptions will continue for longer.
Okay, so hope for the best, plan for the worst. Sensible.
Right, which includes a continued focus on EBITDA dollar growth, not just margin percentage, and proactively disrupting their own labor-based models with more differentiated, tech-heavy offerings.
Got it. What else did analysts push on? Cost cuts? Buybacks?
Yep. They asked about the cost efficiency measures. Management confirmed that the initiatives, including that accelerated AI adoption, are not yet fully reflected in the updated EBITDA guidance.
Suggesting potential upside to guidance if those initiatives pay off faster or bigger than modeled?
Potentially, yeah. On capital deployment, they reiterated a target leverage ratio around 3x net debt to EBITDA with flexibility.
Pretty standard for the sector.
And they plan to buy back between $350–400 million in shares this year. They even indicated a willingness to buy more at these current depressed prices.
Makes sense if they believe the shares are undervalued.
Though they are mindful of not over-leveraging in what's still an uncertain environment.
Right. Balance prudence with opportunism. So what would actually shift management's outlook to a more constructive view? What signals are they looking for to say, okay, things are getting better?
Good question. They laid out a few things.
Okay.
They need to see improved conversion of existing contracts into revenue that on-contract growth needs to pick back up.
Makes sense.
Faster adjudication and fewer delays in new business awards. The pipeline needs to flow faster.
Right. Unclog the bottleneck.
And an increased velocity in the ramp-up of newly won programs. Those big wins need to start contributing meaningfully to the top line.
So basically, all the things that went wrong this quarter need to start going right again.
Pretty much. They did note some signals of normalization for FY27, though they're still cautious on the first half of that year.
Cautious optimism at best for next year.
Exactly. So ultimately, this really does present a prove-it phase for SAIC.
Absolutely. They've got the backlog, they've got the cash flow guidance boosted by taxes. Now they need to execute.
They need to demonstrate their ability to convert that substantial backlog into actual revenue, stabilize that organic growth, and meet those elevated EPS and FCF targets amidst these ongoing macro and government contracting headwinds.
Tall order, but that's the challenge.
All right, it's time for our This Is Not Financial Advice segment.
The fun part, where we get a little speculative.
Exactly. We pitch an outrageous but plausible trade idea, just like you might hear tossed around in a hedge fund meeting. Remember, folks, key word, not financial advice.
Definitely not. Okay, lay it on us.
Given SAI Q2 earnings, here's a thought. The market absolutely hammered SAIC for its revenue miss and cut guidance. Down almost 7%, heavy volume, we covered that.
Yep, clear negative reaction.
Management significantly raised EPS and free cash flow guidance. Now, we know a lot of that is tax-driven, especially the Section 174 stuff.
Right, a big asterisk there. But the cash flow number is still pretty impressive.
It is, and they still have strong bookings and that hefty $23 billion backlog.
Okay, so the setup is Market focusing on revenue fear, management pointing to profit cash fact, even if tax-aided, and a big pipeline.
Precisely. So here's the contrarian thought. Maybe the fear of revenue contraction has overshadowed the fact of strong earnings and cash flow, creating an opportunity.
Okay, I see where you're going. A potential overreaction.
Exactly. Our audacious idea. A deeply out-of-the-money call option spread on SAIC may be expiring in, say, 6 months.
Ooh. Okay. Option spread. Leveraged bet. Why deeply out of the money?
Because it's a lower probability bet. You're not betting on a small bounce. You're betting the market eventually looks past the immediate top-line anxieties and recognizes the underlying profitability, cash generation, and strategic acceleration.
And the spread structure limits your risk compared to just buying calls outright.
Right. You're leveraging the perceived overreaction, betting that even if the revenue picture remains tough short-term, the company's ability to drive cash and earnings.
Right.
Plus significant share repurchases at these lower prices.
Buying back stock cheap helps EPS too.
Will eventually lead to a re-rating. Maybe not back to peak levels immediately, but certainly a recovery from this sharp dip, maybe closer to its peer group valuation.
So it's a low probability, high payoff bet that the fear has eclipsed the fact.
That's the thesis. The market panicked about revenue, maybe ignoring the cash flow reality, even with the tax help. Again, definitely not financial advice, just a thought experiment.
Got it. An interesting contrarian angle, playing the sentiment versus the numbers.
So to recap our deep dive into SAIC's Q2 FY26 earnings.
Let's wrap it up.
We saw a company grappling with definite near-term revenue headwinds, driven by government efficiency efforts, delays, leading to that cautious revenue outlook.
The tough part.
However, this was powerfully counterbalanced by a strong beat on profitability and free cash flow, significantly aided, we should stress, by that favorable tax settlement and those crucial Section 174 benefits.
Right. The good part, albeit with caveats.
And management is aggressively accelerating its long-term strategy, focusing on higher margin work, AI adoption, which they believe will lead to normalization and growth eventually, maybe starting FY27.
Using the crisis narrative.
Right. So here's a provocative thought for you to consider as we close out. Despite the market's immediate skepticism, is SAE effectively using this prove-it phase and these external disruptions as a catalyst? Could they actually solidify their position for more durable, higher margin growth in the evolving government contracting landscape?
Making it potentially a compelling long-term value play that short-term traders are currently overlooking because of the revenue noise.
Or will these temporal headwinds prove more stubborn than management thinks? Will they linger, validating the market's current cautious stance and the stock's underperformance?
A key question for investors right now. Is it a temporary storm or a change in climate?
Exactly. Something to chew on. Thank you for joining us for this deep dive. As always, this analysis is for informational purposes only and should absolutely not be considered investment advice.
Please do your own research and due diligence.
You catch you on the next call.